Thank you, Mr. Chairman and members of the subcommittee. My name is Dan Mitchell. I'm a senior fellow at the Cato Institute, and I appreciate the opportunity to summarize my testimony here. Our nation faces very serious long-run fiscal challenges thanks to changing demographics and poorly designed entitlement programs. All of you know that from various reports from CBO, OMB, GAO, private forecasters. I would say all these estimates that we get tend to focus on the red ink, which I think is useful information, but I also think it's incomplete because what we should be focusing on is the underlying burden of government spending. The red ink is the symptom. Excessive government spending is the underlying problem. And that spending, whether it's financed by taxes, borrowing, or printing money, that's what entails the diversion of resources from the productive sector of the economy. It's also best to focus on government spending because projections of ever larger levels of long-run debt are the result of ever-expanding amounts of federal spending, not inadequate tax receipts. If you look at the CBO numbers that just came out, it's very clear that tax revenues already are above their long-run average. And not only that, but they're going to continue to increase over time, mostly not because of legislated tax increases, but simply because of some parts of the tax code aren't indexed to inflation, and also even low levels of economic growth will result in some what's called real bracket creep over time. So when you're looking 1 decade, 2 decades, 3 decades down the road, federal tax revenue will be growing as a share of the economy. So the problem that we have with our long-run fiscal forecast is not on the revenue side of the equation. Revenues are growing, but the burden of government spending is growing even faster. And as I mentioned before, it's largely because of entitlement programs combined with changing demographics. A reasonable sized welfare state is possible when you have a traditional population pyramid. But because of aging population and falling birth rates, we're moving toward a population cylinder, and that's going to create very, very serious problems. Indeed, if you look at some of these forecasts, we're on a path to becoming a failed European-style welfare state. As a matter of fact, if you look at some of the long-run numbers, not only from our own agencies, but if you look at what the International Monetary Fund is projecting, the Organization for Economic Cooperation and Development, Bank for International Settlements, they all show numbers that are actually worse than what you see in terms of the long-run forecast for France, Italy, Greece, and places like that. Now, I actually think those estimates are a little bit too pessimistic because they're basically premised on the notion that we have this big built-in increase in government spending and tax revenues are growing only very slowly as a share of the economy, and they assume compounding levels of government debt. Well, we can actually solve that problem relatively simply by simply putting a cap on government spending. And so even though these long-run forecasts show us with more long-run debt than France and Greece and Italy, I actually think our problem is much easier to solve because they're already at levels where government is consuming more than half of the productive sector of the economy, and their tax burdens are at or above the revenue maximizing level. That's a much, much harder problem to solve. So the question is, we do have this long-run problem, however you measure it. How do we solve it? Should the debt limit be an action-forcing event for fiscal reform? And my conclusion is yes, because it beats the alternative. And here's an example that I shared with the Senate Budget Committee a couple of years ago. Look at Greece today. A very deep recession, completely miserable economic situation, incredibly high levels of unemployment, including 50% unemployment for young people. Why are they in this mess? Because they hit a fiscal crisis. Imagine, though, if 15 or 20 or 25 years ago, Greece had something akin to the debt limit, some action-forcing event. And let's say that some lawmakers 15 or 20 or 25 years ago threw sand in the gears, caused shutdowns, caused debt limit fights, whatever you want to call it. But imagine if all that had forced Greece to engage in reform. It might have caused a little bit of discomfort then, but it would have saved the Greek people from much, much deeper levels of misery that they're suffering now. And I sort of view the whole debt limit fights or government shutdown fights, any of the fights that we're having now, sequester fights, they're basically an opportunity to save America from enduring that kind of suffering that the Greek people are dealing with. And so that's why a debt limit fight or some other fight would be necessary. Now, there are, of course, arguments against this approach. One of the arguments is that, and we saw this with the July 2015 GAO report, is that, if you have these debt limit fights, what's going to happen? You're going to have higher levels of interest on the debt. Again, that's peanuts compared to the long-term suffering that might occur. And the other argument is that you're going to have a default, or you're not going to be able to pay interest on the debt. And I'll close with simply the point that in 2017, the next time we have a debt limit, CBO projects that revenues will be more than $3.5 trillion, and they project that interest on the debt will be $308 billion, more than 11 times as much revenue as would be needed. So prioritization, not desirable, but it would work. Thank you.